In 2006, a bus driver in Florida owned 5 houses. He had no savings, no financial background, no plan, just 5 mortgages and the absolute certainty that housing prices only go up. 2 years later, all 5 houses were worth less than what he owed. He lost everything. And he wasn't alone. Millions of people, regular people, smart people, people who should have known better, made the same bet. They were all wrong, at the same time, for the same reason. Let me show you how an entire country convinced itself that the impossible was inevitable. Here's what happened in the simplest possible terms. Banks had money, lots of it, and money sitting around doing nothing is worthless. Money needs to work. It needs to earn more money. So banks needed to lend it out, find people who wanted to buy things, charge them interest, make profit. Housing was perfect. Everyone needs a place to live. Houses are expensive. People need loans. And historically, housing prices go up, slowly, steadily, boringly. So banks started lending money for houses. Normal stuff. You want a house, you get a mortgage. You pay it back over 30 years. Bank makes money on interest. You get a house. Everyone wins. But then someone asked a dangerous question. What if we could lend more? Not to better borrowers, not to people with more money, just more. To anyone. To everyone. That question changed everything. Traditionally, getting a mortgage was hard. Banks wanted proof you could pay them back. Steady job, good credit, down payment, all the boring, responsible stuff. Why? Because if you couldn't pay, the bank was stuck. They'd have to take your house, sell it, hope they got their money back. Messy, risky. Banks hated risk. But in the early 2000s, something shifted. Banks realized they didn't have to keep the risk. Here's how it worked. Bank gives you a mortgage, but instead of holding on to it for 30 years, they sell it, package it up with hundreds of other mortgages, sell the whole bundle to investors on Wall Street. Now the bank has their money back immediately. They can lend it out again to someone else and sell that mortgage too. The risk, not theirs anymore. It's whoever bought the bundle. This changed the incentives completely. Before, banks were careful. They needed you to pay back the loan because they were stuck with you for 30 years. Now, they just needed you to sign, because the second you did, they'd sell your mortgage to someone else and move on. So, banks stopped being careful. They started lending to anyone. People with bad credit, no savings, unstable jobs. Didn't matter. The mortgage brokers didn't care if you could actually afford the house. They got paid when you signed. What happened after wasn't their problem. This is where it gets absurd. Banks started offering mortgages to people who absolutely, clearly, obviously could not afford them. There were mortgages with no down payment. Just walk in and get a house, $0 up front. There were stated income loans. You just told the bank how much you made. They didn't verify, didn't check, just wrote it down and approved you. People called them liar loans because everyone was lying. Borrowers lied about their income. Brokers helped them lie. Banks didn't care because they were selling the mortgage anyway. There were also adjustable rate mortgages, low interest rates for the first 2 years. Then they'd spike, sometimes double. People thought, I'll refinance before the rate goes up, or I'll sell. Housing prices always go up. I'll make money. Everyone believed this. Buyers, brokers, banks, investors. The bus driver in Florida with 5 houses, he was using the theoretical future value of his houses to buy more houses. It was speculation, pure gambling. But nobody called it that. They called it investing. They called it building wealth. And it worked. For a while, housing prices did go up, fast. In some places, 20% per year. People bought houses and sold them 6 months later for massive profit. It became a frenzy. Everyone wanted in.
If you weren't buying real estate, you were missing out. You were the sucker. FOMO became economic policy. Here's the problem. The whole system was built on one assumption. Housing prices will keep going up. If that's true, everything works. You can't afford your mortgage? Refinance. The house is worth more now. You have equity. Banks will give you a new loan. Can't refinance? Sell. Make a profit. Move on. But what if prices stop going up? Then you're stuck. You can't refinance because you don't have equity. You can't sell because no one's buying at your price. You're trapped in a mortgage you can't afford. And if enough people are trapped, the whole thing collapses. That's exactly what happened. By 2006, housing prices had gone up so much, so fast, that normal people couldn't afford houses anymore, even with the crazy loose lending. Demand started to slow, prices stopped rising. In some places, they started falling. Now, all those people with adjustable rate mortgages, the ones with low rates that were about to spike, were in trouble. They tried to refinance, couldn't. The house wasn't worth enough. They tried to sell, couldn't. No buyers. So they stopped paying, defaulted, walked away. And when they did, The banks took the houses back. Foreclosures. Suddenly, banks owned thousands of houses they didn't want. They tried to sell them, flooded the market, prices dropped more. More defaults, more foreclosures, more houses on the market, prices dropping further. It was a spiral, and it was fast. Remember those bundles of mortgages banks sold to investors? Wall Street loved them. They were supposed to be safe. Mortgages are backed by houses, real assets. People pay their mortgages, reliable income. So Wall Street bought billions of dollars worth. Pension funds, insurance companies, foreign banks, everyone. But here's the trick. Wall Street didn't just buy them, they sliced them up, repackaged them, made them complicated. They took mortgages, some good, some terrible, and bundled them together. Then they got rating agencies to call them safe, AAA rated, same rating as government bonds. Except they weren't safe. They were packed with liar loans and adjustable rate mortgages given to people who couldn't afford them. But nobody looked closely. Everyone trusted the rating, and everyone kept buying. When people started defaulting, these bundles, these safe investments, became worthless. Suddenly, banks and investors holding billions in mortgage-backed securities realized they were holding garbage. Lehman Brothers collapsed, Bear Stearns collapsed, AIG needed a bailout. The entire financial system started seizing up. Because it wasn't just about houses anymore, it was about the debt, the leverage, the interconnected bets everyone had made on housing. When housing crashed, everything crashed. This wasn't an accident, it was inevitable. The system was designed to fail. When you remove consequences, people take bigger risks. Banks weren't holding the risk, so they lent recklessly. When you base an entire economy on the assumption that one thing, housing, will go up forever, you're building on sand. Nothing goes up forever. Not housing, not stocks, not tulips in 17th century Holland. But everyone wanted to believe it, because believing it made them money. The brokers made commissions, the banks made fees, Wall Street made profits, homeowners felt rich. Everyone was winning, until they weren't. And the warning signs were there. People saw them. Experts warned about it. Some investors bet against it, shorted the housing market, and made billions when it collapsed. But most people ignored the warnings because it's hard to believe a party will end when you're still having fun. The crash was inevitable because the growth was unsustainable. It was built on debt, speculation, and the belief that prices would rise forever. When belief faded, the foundation crumbled. The crash destroyed lives. Millions of people lost their homes, lost their savings, lost their jobs as the recession spread. The unemployment rate hit 10%. The stock market lost half its value. Entire neighborhoods were abandoned, full of foreclosed houses. And the people responsible? Most of them walked away fine. Banks got bailouts, executives kept their bonuses, the rating agencies faced no real consequences. Meanwhile, regular people, people who thought they were doing the right thing, buying a home, building equity, lost everything. The bus driver in Florida, he was just trying to get ahead. So were millions of others. They were sold a lie, that housing was a safe bet, that prices only go up, that everyone could be rich if they just borrowed enough. And when the lie fell apart, they paid the price. You might be thinking, okay, but that was 2008. We learned, we fixed it. It won't happen again. Maybe. Lending standards are tighter now, banks hold more capital, there are more regulations, but the fundamental incentives haven't changed that much. Banks still profit from lending, Wall Street still loves packaging debt, people still believe their house is a guaranteed investment. And housing prices, they've been rising again, fast. In many cities, faster than incomes. We're not in a bubble like 2008. The situation is different, but the psychology isn't. People still believe housing prices will keep going up, that they need to buy now or miss out forever. That feeling, that fear of missing out, that's what fueled the last crash, and it's still here. The 2008 housing crash wasn't a random disaster. It was the predictable result of a system that rewarded recklessness and punished caution. Banks lent to anyone, borrowers took on debt they couldn't handle, Wall Street packaged it all up and called it safe, and everyone believed housing prices would rise forever. They were wrong. The crash was inevitable because the growth was fake, built on debt and speculation, not real value. Millions of people lost everything because they believed a lie. Here's the question we should be asking. Are we believing a similar lie right now? Housing prices are high, student debt is at record levels, corporate debt is massive, everyone's borrowing, and everyone believes it's fine, that this time is different. Maybe it is, but in 2006, a bus driver owned 5 houses, and everyone thought that made sense, until it didn't. Thanks for watching. If this made you think twice about what everyone knows is true, hit subscribe. And remember, when everyone believes something is inevitable, that's usually when you should start asking questions. See you next time.